Ladies and gentlemen, we are living in one of the most interesting and extreme bull runs in stock market history. While I sit here looking at my portfolio pushing to all-time highs, there's one phrase that comes to mind, and that's FOMO, fear of missing out. I'm sure if you were scrolling through the forums this morning looking at your stock portfolio, you probably saw Tesla cross over the jaw-dropping $500 a share mark, which was absolutely absurd. And I'm not saying there's anything wrong with celebrating capital gains, but I think it's always a good idea to keep your ego in check and keep your moral compass heading in the right direction for your financial independence, retire early journey. So today we're going to hear some quotes from the most successful investors in stock market history to hopefully keep you heading in the right direction. Some of these you're going to be familiar with, and some of them you probably never even heard of before. So ladies, gentlemen, I look so forward to breaking this down for you. So let's just jump right into this.
Drop it.
Welcome back, my passive income investors alike. This video is going to hopefully keep your ego in check. My personal stock portfolio just crossed 136,000 CAD, which seems almost a little bit too good to be true. And I'm not complaining because I am a dividend investor and I've seen my account take major dips as well. But if you're new to stock market investing, these are some of the first gains you might be experiencing. I'm going to share with you some quotes that'll hopefully keep you a little bit more humbled as you go forward. So starting with, the stock market is filled with individuals who know the price of everything but the value of nothing. This is advice that is really overlooked as it was some of the biggest influence on Warren Buffett. This is from Phil Arthur Fisher. In the 2018 Berkshire Hathaway annual shareholders meeting, Warren Buffett called Fisher's Common Stocks and Uncommon Profits a very, very good book. He further described how Fisher's scuttlebutt technique continues to be a good way to investing, which is still used by Ted and Todd at Berkshire Hathaway. If you don't know Ted and Todd, they are the current main investors that have taken over for Warren Buffett. John Train described Warren Buffett as 85% influenced by Benjamin Graham and 15% by Philip Fisher. For our second quote of the day, the four most dangerous words in investing are, "this time it's different." This relates to so many different aspects of the market, but this guy has some insane credibility. Ladies, gentlemen, have you ever wanted to be the person that picked up shares after the 2008 crisis? Heck, well, this guy took it a step farther by probably buying in one of the worst times in human history. Sir John Templeton, during the Depression of the 1930s, bought 100 shares of each New York Stock Exchange listed company, which was then filed for less than $1 a share, with inflation to be $18 today. It was 104 companies, 34 in bankruptcy in 1939. Later making many times the money back when the USA industry picked up as a result of World War II. According to Templeton, he called this broker the day World War II began and instructed him to purchase every stock trading at less than $1. You want to talk about a gutsy move in the stock market when everyone was going to war, half the country was leaving to go and fight. Here's this guy, just picking up shares in the stock market. I can't imagine what times would have been like back then. Now for a quote coming from an investor many of us know, but advice that I think is severely overlooked, is why diversification is only required when investors do not understand what they are doing. And I'm going to further extrapolate this, but this obviously comes from Warren Buffett. In the beginning, diversification is relevant. Once you've gotten your feet wet and have confidence in your investments, you can adjust your portfolio accordingly to make bigger bets. This advice, I think, is the hardest for today's investors to follow because of M1 finance and fractional share buybacks, which is something that I speak out against. Because if you are going to only have $500 or $1,000 invested in the stock market, I don't think it's wise to invest that between 50 or 100 companies. Now, Warren Buffett also said that ETFs were basically for ignorance, because if you don't know what you're doing in the markets, and say, there's nothing wrong with this, by the way, but say you want the markets to be 100% passive, you don't want to have to think about it, well, buy the broader index or the Vanguard index fund. But if you are buying individual stocks, I don't suggest doing it $1 at a time through M1 Finance, because you're not going to be invested into the company, and you start getting into the dumb money phase where essentially the investments you're making are based off what other people think, and you've never actually fully done your homework, and you're trying to build your own index fund. I personally hold 12 stocks between $130,000, which I think is the appropriate allocation between the stocks that I like and know And that is correlated properly, I think, with the risk I'm taking versus my age. And I'd love to know what you guys think and how you have your portfolio currently laid out. Are you somebody buying fractional shares? And I do know people that do well buying a portfolio of fractional shared companies. I just personally don't see the interest in it for me. Now, moving into a quote of a guy that I think has influenced many of us, a very famous investor. Financial peace isn't the acquisition of stuff. It's learning to live on less than you make, so you can give money back and have money to invest. You can't win until you do this. And I didn't start winning until I did this. And of course, this advice comes from the more recent great Dave Ramsey. The Total Money Makeover is Dave's how to approach for living out the baby steps in everyday life. So Dave Ramsey runs a program of what he calls the baby steps to help get you out of debt, get an emergency fund filled up, and start actually investing. And, you know, I'm sure you've heard of his debt-free scream. If you don't, go check him out on YouTube. You can look him up. But this advice is extremely crucial because the day I became wealthy and actually successful in stock market investing was the day I realized it wasn't about the stock market that was making me rich. It was about my living habits and my philosophies around how I invested, and that has given me a rate of return of somewhere around 20% a year, which is absolutely ridiculous. I know I have a hard time usually in my other videos. I kind of underplay my rate of return, saying it's usually around 16% a year. It fluctuates greatly holding individual stocks, but I think it's important to constantly remind ourselves that it's the philosophies that give us the returns. It's not actually us just buying the stocks, because we have to live below our means, and I'm sure we all have those ball and chainer friends that have to buy new cars. You know, they're making their 70, maybe 80,000 a year salary, but they don't put any money away, and they're the definition of broke. And Dave Ramsey is a big advocate of helping people get through this philosophy of investing, because this is the kind of philosophy that everyone, including Warren Buffett, follows. And if you do not adopt this kind of philosophy, well, don't ever expect to be a successful stock market investor. Which leads me into the final quote I want to share with you today. It's not how much money you make, but it's how much money you keep, how hard it works for you, and how many generations you keep it for. Wow, what a good follow-up to the last quote, because obviously if you don't got the fundamentals, you're not taking on the somewhat of a minimalistic lifestyle, putting away and putting off some luxuries so you can get into this, because you got to have some money to put away, and that's how you get some money to put away. And then on top of that, you obviously want to do it with some intelligence, so you're getting some returns, and then it's having the guts to hold on to these investments, because man, when you're looking at a company like Apple right now, my portfolio, you know, pushing up over 80% returns, I have to remind myself that, look, I'm not going to be able to buy something better than this, and you have to keep holding on to it. It's also tricky to hold stocks and not sell them on the upside, is just as much as it's dumb money that doesn't sell it when it goes to the downside, because when stocks turn around, people are always like, oh, it can't go any lower than this, right? So, I mean, there's kind of the weird opposite infliction on both sides of the market. And this advice comes from a gentleman I'm not the biggest fan of anymore, but still heeds some incredible advice and influence on the investing community, is Robert Kiyosaki from Rich Dad, Poor Dad. Now, the Rich Dad, Poor Dad philosophy has read through the hearts of many investors in the community. And if you've never heard of this advice, I highly suggest you go watch some videos on YouTube on this, because he talks about living with his rich dad and the advice that he got from his poor dad about going to school, getting a good job, even though his poor dad never had any money, whereas rich dad was telling him to buy businesses, get assets, and invest. And that is what you're doing as a stock market investor. Now, if I can heed you some of my own personal advice in this market, is don't become dumb money. Don't become a FOMO, a fear of missing out person, because it's in moments like these when, if the market does decide to go the other way, you're going to see even more volatility to the downside. And the reason I know this is because dumb money doesn't have the intelligence to stomach the volatility of the downturns in the market. I hold companies that I know in and out can survive recessions and keep paying me paychecks every month or every quarter, because these are staples to societies. A lot of people are jumping into the MJ sector. They're jumping into highly volatile and heavily leveraged with debt companies, and if the stock market turns around at any point in time, those are the companies that are going to do extremely poorly. And because dumb money doesn't know when to get out or what they're doing, fear and emotion will take over their decision making, and they usually do one of two things, which is either hold on as these companies go bankrupt, or they sell out at a loss and get this stomach feel of not wanting to invest farther into the future. And it's times like these where I'm reminding myself of, you need to be with the right people and in the right community. If you guys want to join our community of passive income investors, investors and successful stock market investors. Come join our chat group. We're also going to be introducing a new product soon where you can actually get advice from professional investors one-on-one. I'm going to be launching that very soon with Map Money, so look forward to that on Passive Income for Dummies. So what I need you to do is slap that like button if you guys enjoyed the advice, and comment on advice that I missed or something that might be able to help out the community on our wonderful YouTube channel, guys. So stay cool, stay awesome. I look forward to chatting to y'all real soon.